Good afternoon, everyone. This is my last one of these to do for 2022. This is the 21st of December, and I hope things are going well for you. I'm hearing from friends of mine all over the country that Santa Claus is going to be coming with a flurry this week. I was just visiting with a dear friend from Chicago, and he's telling me they're expecting 60 to 80-mile-an-hour winds tomorrow and Friday, and probably wind chill factor of about 15 or 20 below. So those of you in Texas, where it may be 10 to 15, just be thinking about people not far from you that are going to be a lot colder than you are. But I hope you guys have a great Christmas and a wonderful New Year. I want to spend a little bit of time talking about what has been, what is, and I believe what will be. And as we normally have done, share with you some of my dear friends and people that I have been following for many, many years. So in addition to this video, there will be a couple of things that Amy Coulter will be attaching to this, and you can read on your own from Brian Westbury and from Bob Dahl. So let's talk about the year from hell, which is pretty much what we have seen in the last 12 months. I've been in this business almost 30 years. I have been trading stocks pretty significantly for 42 to 44 years. And so I have never seen a year quite like this. The closest by far, and if you do much research on the internet, you're going to see this, was the year 2008. That was the year of the housing crisis, where we had the second and fourth largest banks in America go under in one weekend, Lehman Brothers and Bear Stearns. Merrill Lynch went under and was bought by Bank of America. Wachovia went under, the brokerage firm, and was bought by Wells Fargo. All of this happened in 2 weekends. No indication that we're quite there, but just as far as the stock and bond markets, we look similar to that. So how did we get here exactly? In March of 2000, we find a thing called COVID-19 that no one had ever heard of, no one had ever seen. It appeared to be, and perhaps was, a worldwide pandemic. And so everybody in the world shut down, from China to Japan to America. People were staying at home. The government felt like they needed to print money and send it out to all of us, which they did. And that happened. It worked probably better here in America than just about any place else in the country, certainly in the world, rather, I meant to say. Better than Europe, better than South America, absolutely better than China, because they're still locked down to a fair extent from all of this. But what happened was all of the supply chain blew up. Shipping from overseas went away. Rail cars went away. Trucking went away because virtually nobody was working and nobody was making cars. And there were nobody cutting trees down, and there were no pulpwood factories to make plywood. And so you had literally the economy turned off as if it were a switch, and no one had ever attempted anything like that before. And so there was great consternation, and I think now we look back and say it was justified. What are we going to do? So the government began printing money and printing money and printing money and printing money, and basically the equivalent of 2 years worth of additional stimulus above and beyond what would normally be paid out in paychecks and Social Security and Medicare and so forth. So now, from about 6 months after that, I will show you the chart that I've been showing you all year. What happens is the economy begins opening up a little bit, and people have money. And now all of a sudden, people are buying boats, and they're buying cars, and they're buying houses. And it's what we call, a friend of mine who lives on a river, in a beautiful river in Colorado. He said every week he would go to the river, he would see new boats, and everybody around him says those are stimmy boats bought from stimulus money. So the market went crazy in the latter part of 2020 and 2021, but there was a reckoning. So the Federal Reserve's job is to keep everything in line. And so if there is too much money chasing too few goods, as we had a year ago, Everybody wanted to buy a new car, except there were virtually no new cars. So you were paying 25, 30% more for a used car than you needed to. Eventually, that will eradicate itself. It will basically line out, and our supply chain, which is improving, that is ships coming here from all over the world, and rail cars and truck drivers, assuming there's not a rail strike, all of that will equilibrate, but at this point in time, it is still very much out of balance. So what you have happen is inflation. The Federal Reserve is bound and determined to crush inflation because inflation is the silent killer. It's especially the silent killer for retired people or those looking to retire or those who are on below average income. It is an absolute killer. And if inflation becomes embedded in our economy, it is almost impossible to get out. That happened in the 1970s. We had about a decade of what we call stagflation. And that is, well, people were getting 5% raises, but inflation was 5%. So everything was pretty much dead. How does the Federal Reserve believe that they need to right this problem? Raising interest rates. By raising interest rates. Amy is sitting next to me, a young lady that sends these videos out, and we just took a look at my neighborhood in Columbia Lakes. And there are 300 new houses that are built in my neighborhood. That neighborhood is 50 years old. Now, there are signs saying this was $427,000 last week or last month, and now it's $327,000. So all these people believe that trees grow all the way to the sun are finding out that they don't. And if you said, I got to buy a house now, I got to buy a house now, they're only going to go up. Well, nothing goes up forever. So these houses are now $75,000 to $100,000 less than they were 3 months ago. And you will see builders going bankrupt, and you will see mortgage companies going bankrupt, and you will see all types of companies going under. But this is the only tool that the Federal Reserve is using, raising interest rates to basically slow down the economy. Ultimately, what happens is it slows down businesses, and businesses lay off people. You're listening to the Federal Reserve right now. They're telling you basically that we're modeling 4.6, 4.7% unemployment, and we're currently at 3.7. Well, what does that mean? Well, that's about 3 million people they are expecting will lose their jobs in the next 6 to 9 months. That's what's being modeled in by the Federal Reserve. All of this is done to try to get us back on some even keel. The challenge is for most people who are see things the way I see things, the Federal Reserve is only dealing with half the equation. We're going to destroy demand. We're going to make it where people can't buy houses, where people cannot buy cars. But there's a whole other side called the supply side. If we fix problems where there are more vehicles available and there's more plywood available and more sheetrock available, things will get cheaper and inflation goes down. How does this all work with regard to the stock market? Quite simply this. Inflation basically eats into the earning power of every company. It just simply does. There's just no way around it. So what you have happen is raising rates and raising rates and raising rates. We have 4 75 basis point hikes and now a 50 basis point hike, and that is the fastest by far it has ever been done in this nation. Ultimately, what happens is companies start losing money. They start dropping their earnings. When we take a look, so let's take a look at something that we've been looking at now for a year or more, and this basically is year to date where we are on the 500 biggest companies in the S&P. So we're down about 16%. A month ago, we had for the second time a very nice run up, and these are what we call bull market runs in a bear market. So you can kind of see the numbers here. What you see is things that are value based, and you'll see this as we go down, have done a little bit better. What I show you, and I'm going to show you again toward the end of this, is look at the 5-year and 10-year numbers on the S&P 500. This is basically what you see the S&P doing for the last 40 years. And there's a lot of math behind why that happens. So we had a really great year. And you can see even as ugly as this year was in the last 12 months, the 3-year average, we are still at 10%. Now, I'm going to come back to that in just a moment. So take a look at how predictable the 3-year, the 5-year, and the 10-year is. The reason why oftentimes people who don't know what they're doing say, oh, the market's going to zero, it's going to crash, we're all going to burn up, gravity's going away. It isn't true. The simple fact of the matter is, you're looking at something around a 10% return in the S&P 500. It's been that way for a long time. I'm just going to tell you the wealthiest people in America, if they can't make money at Amazon or with Apple or with Google, they will take their money into private equity or other places. That's what causes companies to go under from time to time. There's as many as 20 or 30 new companies in the 500 largest companies in America every single year. So now looking at this going down, here has been the major problem by far. This is bond yields. And we've talked before about in a normal world, 50% stock, 50% bonds. Stocks will move opposite of bonds 90 to 95% of the time. There's a lot of data that goes into that. Well, this was one of those 5 to 10% years where that did not happen. So what you're seeing here is 12-month numbers on a 30-year treasury down 30%, a 10-year treasury down 15%. And you see all types of corporate bonds right down here. We were down as much as 13 to 15%, which is about the same as what the stock market has been. So what I would say to you is this is all correcting itself. If you take a look at the last month, look in the last month, and what you see is a 2-year government bond is up almost 1% in the last month. You see this 10-year government bond, this 10-year treasury is what housing mortgage rates are based on. This 10-year number, it's up almost 5% in the last 30 days. So we are coming out of this. I think going forward, we will probably have another 3 to 4 to 5 months of ugliness. But there's 2 things I will tell you. First off, markets always look ahead. The market will move 3 to 6 months and much as 8 months ahead of the economy because all of the numbers you see are based on future earnings expectations. What will these companies make in March and June and September of next year? When companies begin guiding up the multiple, how much do you have to pay for $1 of earnings of a company will go up, and that causes the market to go up. So this fundamentally is where we are. This has been an ugly year. I think we have another 3, 4, 5 months. We absolutely have been in a trading range for some period of time. This is 1-year numbers. And what I have shown you a number of times is we basically have been in a trading range, especially if you take a look at this line. This goes all the way back to May. So in the last 7 to 8 years, you can see what 7 to 8 months rather, literally going back a year, what you will see is we've been in a range from here to here. This number, if you take a look at the right-hand side of my screen right over here, this number is about 20%. That's what's called a bear market. And it is very common in troubling times for the market to sell off 20%, which is where it's been. And every time you've seen that happen, and you can basically take this number, you see that's October 14th. This is October the 12th, my birthday. This is September 30th. This goes all the way back to June 16th. What you see is these numbers are within a couple of tenths of a percent. What does that mean? What it means is stocks are fairly valued. Most of the investors, the serious money, believes what they are paying for stocks right now is a fair value for what that company is currently making and what they believe it will make going forward. So I just would say to you, this is where we are, and we're going to probably be like this. You can see this nice bull run that happened here. We went from being down 20%, 19 and a half, to only down 5. We come back to that point, we're up now about halfway back, just slightly less than halfway back. There is normally what's called a Santa Claus rally. We're having part of that today. That's when people have dumped all of their capital losses and capital gains, and companies are doing what's called, and I'm talking about investment companies, are doing window dressing. You will see a pretty nice pop probably from now for the next 3 to 4 weeks. And we may even test some of these numbers up in here, but we're not out of the woods yet. Look at this number that I've talked about before, and this is just a graphic version of what I was showing you a minute ago. And that is if I take this number, this is 5 years to the day, and I put it right on the dot where we are right now, we are up 51%, 51.74%, which is, you divide that number by 5, and we are just a tad over 10%. When you see this market make this sizable move up here, and you can see all these numbers, how high this market went. Just take a look at this for a moment, because this is a reversion to the mean. If you go back and take a look at the purple line that I have drawn here, you're going to see all the way back to 5 years ago today, where I put my cursor. Look at how much that market tracked that 5-year line until about July to August of 2020. That's when all the stimulus money started heading in. And with that, you see this giant run up here, and we come back, and what sometimes people are believing is the end of the world is, in fact, we are back to that number. So the very same number that I showed you a little bit earlier that showed 3-year numbers on the S&P are 10%, 5-year numbers are 10 to 11%, 10-year numbers are about 12%. That's pretty standard. A lot of what you see happening now, to just finish up, is how the big institutional guys get the do-it-yourselfers out of the market. They will back away from the table, and I can tell you, I have conference calls with the people that are managing your money on a regular basis. Shelby and Jeremy and I listen to many, many of them. I know when they're backing away from the table. I know when they come back in. And you want to know, why do you see a hard bottom put in certain places, like you see right in here? That's when the Fidelities and the State Streets and the Blackstones and the BlackRocks and the Vanguards and the American funds are coming back in, and a number of other firms. So this is part of how they clear the playing field and get the small time or the individual investor out. And unfortunately, for a lot of young financial advisors who have not seen a time like this, like we had in 2008 and 9 and 2001, 2, and 3, sometimes they panic and do strange things. Get me out of the market. Well, they don't ring a bell at the bottom, just like they don't ring a bell at the top. So when do you get back in when you get out? And I'm going to tell you, to close this, we are 20 to 25% cash, and we have been since June. And I've talked about that many, many times. We are making some moves from actual cash to money market type instruments, and a number of you will see chunks of money being bought. Shelby's doing that with a little bit of work on my end, because this is a little bit longer than what we had anticipated. I want you to make 4 or 5% off of your cash instead of 1%. So we're doing that. We are still in the process of moving people into real estate, and quite simply, it is, I want a bond replacement. I want something that pays me 5% every single month. And I also want something that will go up, that your principal will appreciate. That's why we're doing hard assets, which is real estate, in some cases gold and silver as people prefer it. But real estate, we want a 10 to 12% return with about half of that paid out in the form of monthly or quarterly dividends. Many of you are taking income from your portfolios. Had this sell-off been 3 to 4 months, we would have just stayed in cash. I believe we have another 6 to 9 months, and I don't want to dig any more into people's principles. So we're starting to make the money markets what we would call a money market equivalent. And right now we can buy 2-year and 5-year government bonds and get 4 to 5% return because interest rates are so high. So that's all I had to say. I've been a little bit longer than I was expecting to, but I hope this is a benefit to you. Let me just say that we had a great dinner on December the 3rd here in Lake Jackson, had about 100 people at it. We are in the process of doing something in the Hill Country, maybe 1 or 2, if we can find a central location, and I will be asking some of you to be involved in helping us pick that. We also will be looking at doing a dinner in Tyler, probably sometime in the month of January. So I hope you guys have a great Christmas. I hope that you're around family and friends, and this is a refreshing time for you. I understand it's going to be cold pretty well all over the country, but stay warm, stay inside if possible, and God bless.